The market has been on a wild ride with interest rates staying high, inflation still lingering, and the Fed walking a tightrope. Many investors have been asking the same question. Why hasn't the stock market crashed yet? That's exactly what we're going to unpack today. And today's video is a little different as we're going to cover two more things in this video. A reaction to another very popular YouTube channel, their latest video, and a concern I have with the outlooks I'm seeing for 2026. So right now, a lot of people are scratching their heads wondering, why hasn't the stock market crashed yet? And how is the market still near all-time highs with everything that's been going on? After all, inflation still isn't at target of 2%. Jobs data still feels mixed and the economy looks shaky in parts. And yet, all the major indices like the S&P 500 and the NASDAQ have stayed strong and at or near record levels as 2025 has ended. A lot of people believe that there are a handful of powerful forces that are keeping the markets elevated. But that does not mean that everything is fine. So let's break it down in a way that makes sense. First and foremost, strong corporate earnings, especially in big tech. They've been a huge support for this market. A lot of the recent gains have come from a lot of speculation about future profits and revenue growth tied to the artificial intelligence revolution. And guys, it is a revolution. Investors have been pouring money into companies that they believe are going to dominate AI infrastructure, the chips, cloud computing, and software. And many of these companies have delivered earnings that have beat expectations, not just last year, but this entire year. And that hope has kept a floor under stock valuations, even when other parts of the economy look uneven. Connected to that is the fact that institutional buying remains very heavy, and not just from traditional mutual funds, but also from the quant funds and algorithmic strategies. What these quant funds are doing is they're making decisions based on data models and market signals, and they hold a meaningful chunk of the total market capitalization, meaning large automated buying can keep prices up and buoyant even when other signals are weak. Now guys, remember, these quant funds don't care about valuation. The brilliance of them is they only care about price movement. So it's another reason why I reiterate, don't take short-term price movements to mean anything. It's quant funds reacting to things. Now, another big reason the market hasn't collapsed is monetary policy from the Fed and fiscal support from Washington. The Fed has cut rate 3 times in 2025, and markets are pricing in the possibility of more trimming if economic data softens, which encourages investors to stay in stocks rather than flee to safer, low-interest assets. Lower interest rates make stocks far more attractive because they reduce the opportunity cost of holding equities versus bonds. If you go buy a bond paying 3.5%, you see the stock market up 15%, what are you thinking? You're thinking you lost out. That's the issue there, okay? Now, it is surprising that back in 2022, when rates started to go higher, we all thought that markets would collapse. And they did have a bear market in 2022 and then roared right back to new highs again in 23 and beyond. Now, there's also a strong psychological factor. Investors have become conditioned to believe that downturns will be short and recoveries are quick. Buy the dip has been the absolute best winning strategy over the last 5 years. After the COVID-19 crash, we dropped almost 40% in 1 month. We had a sharp rebound that followed, new all-time highs by the end of the year, and many traders now assume that dips are just that buying opportunity, not the signal of a long-term bear market. Guys, I preach about valuation, and even I believe, it's just a dip, it'll go right back up again. I've bought into that. Now, I don't believe that's going to happen forever, but I look at it going, okay, well, eventually something will happen, but in the meantime, it's just buy the dip. Now, I don't advertise that. I don't tell people go buy the dip because I just don't believe in that in general where valuations are. But it just goes to show that even my mentality has been, all-time highs, they're coming again. And that confidence can paradoxically prop up valuations, prices actually, even when some economic indicators suggest trouble. All of this has combined to keep the market afloat, even though valuations are high and some analysts warn of bubble-like conditions. Not even some analysts. A lot of people are talking about it. It's called the everything bubble that's been going on, but it's especially high right now in AI-linked mega caps that dominate the benchmarks today. It is also worth noting that while the headline market is high, under the surface, There are sectors that are struggling or haven't participated in the rally, and a lot of stocks look massively overpriced relative to the earnings they have and the earnings growth they have in the future. But here's the key takeaway. The market hasn't crashed, not because risk disappeared, but because of a mix of future earnings hope, continued liquidity, AI optimism, institutional participation, and guess what? The bottom line is retail investor has FOMO. They don't want to miss out on what's next, so they continue to buy. These forces can delay or soften a downturn, but they don't eliminate the risk. In fact, the higher markets go away from value, the riskier the markets are. Now, at the same time, high valuations and concentrated stock market growth in a handful of companies mean the market may be more sensitive to bad news than many people want to admit. That is why understanding price versus value matters more than ever for anyone investing today. It doesn't mean stop investing. What it means is be aware of what it means and what that means for the future. So now that we've unpacked why the market hasn't crashed yet, let's take a look at the other side of the coin, because not everyone is feeling so optimistic. There's a popular YouTube channel called New Money, and they just released a video where they break down 3 specific risks that they believe could bring the market down this year. And so my team has given me this video, and I'll be watching it for the first time with you. I have no idea what my reaction is going to be. They might say things I go, actually, that makes sense. So let's react to it together.
Now, the first factor, which would very quickly crash the US stock market, is actually something totally out of our control, and that is China going to war with Taiwan. And believe it or not, that conflict, which would be happening 7,800 miles away from the stock exchanges in New York, would likely have an immediate impact. Why? The US is very dependent on Taiwan for semiconductor chips. Now, I made a video on this recently, but one big problem the US is trying to desperately fix right now is that all of the world's most advanced chips, the ones that Nvidia is selling, the ones Apple is putting in their iPhones and their MacBooks, the ones powering the Magnificent Seven companies to new heights, well, all of these chips are made in Taiwan by one company called TSMC. And here's the thing, TSMC is the only company that can make the world's most advanced chips at scale. And I'm not even kidding. Samsung can do it, but not particularly well. And the tricky thing is that 80 to 90% of TSMC's production happens in Taiwan. Yes, they're trying to move that over to Arizona, but that's a long way off from pumping out the super advanced chips they already make in Taiwan.
All right. So the first thing I'm going to say is everything he says sounds extremely logical. We have been worried about the Taiwan and China issue, but he's very smart for saying this could do it. We also thought that raising rates from 0% to 5.5% would crash the market. It did not. We also thought that raising rates from 0 to 5.5% would absolutely obliterate the real estate market. It did not, and prices continued going sky high. Usually, when something is so obvious to us, that's when it's accepted and it moves on. The Taiwan semiconductor and China, the Taiwan and China issue has been an issue for years. In fact, people hated Baba for that exact reason. Like, oh, China's going to invade Taiwan. We're going to put sanctions. Maybe. I'm not trying to sit there and say he's wrong. He is right by saying it could happen. That's absolutely a fact. It could happen. I don't know. I mean, there's no guarantee of that because everybody's been expecting this for so long. Usually these big things that happen that cause major falls are things we don't see. That's the thing that causes the fall. When you're not prepared, that's when you have a problem.
That's the first crack that could potentially bring markets down in 2026. But next up, I want to talk about a factor that's naturally quite political, and that is the possible replacement, or very likely replacement, of US Federal Reserve Chairman.
I don't need to watch anymore. I disagree. Like, I'm sure there's going to be much more in this, and I'm sure there's much, and I'm dismissing it, and I'm not trying to do that on purpose. I'm doing it for effect to say, guys, no. We were expecting Fed Chairman Powell to get removed. Everybody said this about Bernanke after he saved us after Greenspan. No, I just don't buy this. Could it happen? Anything could happen. But I literally am shocked to even read that. Like, Fed Chair, the first thing I did when I saw this was look for the date on this video. Because I'm like, well, this video must be really old then. I'm like, but guess what? 2 days ago. I was like, wait a second. This has been known for a billion years. I mean, Trump basically campaigned on, I hate Powell, he is gone. I mean, that was Trump's campaign. He was like, hey, I got shot in the ear, vote for me. And by the way, Powell sucks, I'm getting rid of him. I mean, what are we talking about here? I don't buy this at all. I mean, it could happen, but unless there's some other event that happens alongside with it, I don't see this being some triggering point. But again, I could be just as wrong as I'm claiming that this is. So really, who knows it all? But I'm very shocked by this. I literally looked down immediately and said, okay, how old is it? I don't know if we have video on my eyes, but I'd love to be able to show that and say, I immediately looked down to say, how old is this video? Because I thought for sure it was a year old, at least. So anyways, let's go to the next video.
Okay, and that brings us to the third, and in my opinion, the most probable cause of a potential stock market crash in 2026, and that is an AI slowdown. Now, I've spoken about this a lot in the past 12 to 20.
I'm going to pause this right now before we go further and say, I agree with this. Nobody's thinking about an AI slowdown. Yes, it's being talked about a little bit, but people are just like, oh, come on. Anyway. I say it as like, guys, I don't know if it's going to slow down or not, but I will say this. Nobody thought 5-6 years ago there'd be a slowdown in Tesla. Let me go to the main page of our Everything Money website. Tesla quarterly deliveries seen falling. I literally had a friend of mine tell me once, Paul, if there's one thing in the world I would never bet against, it's Tesla or Elon Musk. That was the mindset. And Tesla's still near or at all-time highs, but I do agree with this. Like people, this is the kind of thing that people would, and when I say slowdown, I don't literally mean the slowdown. I wonder if there's going to be a 180 turn, like where it goes from tons of spending to all of a sudden we're not spending at all. And we're saving our capital expenditures as we overbuilt. That is the concern I have. Like electric vehicles. Look at Ford. Ford took a $19.5 billion write-down in the electric vehicles. They stopped the Ford F-150 Lightning for that exact reason. Everybody looks at the world and says, and I believed it too. Guys, there's many videos in which I said EVs are the future. I truly, by the way, I still believe that. I still believe EVs are going to be a big part of our future. The question is, are they going to be as big as everybody thought they were going to be? You know, Kathy Wood and Meet Kevin, and 3 years ago said that by this year, Tesla would be selling 5 or 6 million cars a year. Guys, I don't think they even beat last year, 2024. Their struggle to even sell 1.8 million cars. Okay, you got to remember in investing, it's not about what you know for sure. It's about what can derail that. Doesn't mean you have to be negative and always have the most negative outlook, but this, what he's talking about, is important to remember. When you are buying AI companies, you're buying the opposite of this. You're buying an absolutely perfect situation. In fact, the valuations are calling for even better than perfect. That's very dangerous. So any sort of slowdown, even if it doesn't do the 180, I think that I think is possible. I say 180, I don't mean like a retract, but I'm looking at going, that would really cause problems. Let's continue on.
Since the current bull market began in October 2022, roughly 75% of the gains in the S&P 500 have come from just 7 stocks. Alphabet.
75%. I love this. Let's look at the stat again. Look at this. 75% came from, what do you say, 7 stocks? 7 stocks, the Mag 7. Guys, anytime you're this concentrated, it is a red flag. And these are concentrated on AI. If you ask the question on all of these 7 companies, what's the underlying principle behind them? Basically AI. I mean, even Tesla, it's about self-driving, and that's artificial intelligence. Like, these are the things that people have to remember. Let's continue on.
75% of the gains in the S&P 500 have come from just 7 stocks: Alphabet, Apple, Amazon, Meta, Microsoft, Nvidia, and Tesla. Those companies,
Tesla,
Magnificent Seven, have now a combined market cap of around $21.5 trillion and account for more than 1/3 of the S&P 500 index. Think about that for a second. 1.4% of the companies in the index make up, at the moment, around 35% of the weight. And this enormous rise in the market capitalizations of these companies has, of course, been down to investors getting very excited about how much growth AI is going to bring to each business. Now, I want to explain this by talking about a very commonly quoted metric, the PE ratio. Now, a lot of people say that this is an easy way to value a stock price divided by earnings per share. So normally PE ratios sit in the 16 to 20 range. So if the PE ratio is way higher than that, like Nvidia at a PE of 45, 50, then it's said to be expensive. And if it's lower than that normal range.
I want to see what he says about the explanation here, because this will be really indicative of what his investing mindset is.
Like Valaris, a Monish Pabrai stock with a PE ratio of 10, then it's said to be cheap. But in reality, the PE ratio does not tell you anything about the company's valuation. It actually tells you about investor expectations. So in the case of Nvidia, investors are expecting a high level of growth in their earnings over the next few years, which will lower the PE ratio back to normal levels.
Yeah, that's great.
And on the flip side, investors currently aren't expecting.
Now, what I will say is, I want to reiterate, it's what investors' perception of the future of the company is. That's what he's saying there, essentially. I mean, I'm trying to go in my head and think, like, what part of what he's saying is inaccurate. I don't think he's inaccurate in this. I think he's actually saying it correctly, that high PEs, I don't know. The only thing I'm saying is, do investors really make that connection versus investors just buying a company, it drives the PE up because they expect great things from the company? Are they one and the same? Are they two sides of the same coin? That's probably more like it. But I like that he's saying this.
Aren't expecting much from Valaris, so they simply aren't willing to pay a decent price for where the earnings currently are. Now, here's the thing. All 7 of these big AI companies, Nvidia, Meta, Apple, Amazon, Google, Tesla, Microsoft, they all have quite high PE ratios. Nvidia and Tesla are the standouts, but look at the lowest. The lowest is Meta at a PE still of 29. Now, what does this mean? Well, it means that investors are expecting a lot of growth, but if they don't get it, these valuations will be completely re-rated. And here's the thing, growth today might not be what it used to be.
All right, I like this guy. I don't know, I've never even heard of that. He's got 1 million subscribers. Nobody's even mentioned this guy to me and saying, hey, you sound like New Money or whatever his name is, and I feel bad. And hopefully he sees this video and sees me complimenting, because we did that video one time of somebody and they were very flattered by what we said, because we're very critical of these YouTube channels, rightly so. But to me, seeing the PE explanation is going to tell me a lot about somebody as an investor. Like, what does a high PE mean? And I always say, like, the high PE feels expensive, looks expensive, but what do I always say? But if God came down and said I'm going to double the company's earnings every year for the next 20 years, I'd pay 300 times earnings for the company today. It's going to double every year for the next 20 years. It's a cheap company. But if a company is selling for 5 times earnings, but their profits are going to drop 30% a year for the rest of the time, it's an expensive company. These are the things that you need to remember about investing. It's not just one metric in and of itself. That's why we have the 8 pillars. That's why we look at all those key metrics. It's about telling us a whole story of what to look into deeper. Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're going to get our stock analyzer, our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days, you'll see. This isn't gambling, it's common sense. All right, so we've looked at why the market hasn't crashed, and we just gotten over some of the biggest risks that could push it lower this year. But now let's zoom out a bit, because while fear grabs the headlines, the big institutions, the ones managing billions, tens of billions, hundreds of billions of dollars, they're putting out their forecast for this year. And let me tell you, some of these projections are going to surprise you, not just because of where they think the market's headed, but because of how often these long-term forecasts actually turn out to be accurate or inaccurate. So let's break down what the major firms from JP Morgan to Goldman to UBS are predicting for the year ahead. And I'm going to share my thoughts on what we, as long-term principle-driven investors, can actually do with that information. Spoiler alert, nothing. These forecasts are for the S&P 500, which, remember, is the broad measure of the 500 largest U.S. companies. And there's some other rules involved, but for the most part, that's it. Oppenheimer has one of the most optimistic targets, saying the S&P could hit 8,100 by the end of 2026. Deutsche Bank is close behind at 8,000. Morgan Stanley projects around 7,800. Citigroup and UBS both target 7,700. Goldman sits at 7,600. JP Morgan has a forecast near 7,500. Bank of America is more conservative with around 7,100. Now, if you put all of these together, they point a sort of middle of the ground, not collapse, not explosive gains like we've seen in the last few years, but continued growth with a wide range of possible outcomes depending on how the year unfolds. Guys, if you'd asked me to guess Paul, what do you think these companies were going to do? I would have said, add them all up, divide by whatever number, they're going to probably be around 10% growth. Part of what these forecasts are built on is how analysts think corporate profits will grow next year. That's bullshit. Many firms are expecting earnings between around $320 for the S&P. Then they apply different price to earnings multiples, essentially a way. All they're doing, guys, is saying, well, the market's in a bull market, so I don't want to say it's going to go to 5,000, so I'm just going to say a higher price, and it's always around 10% higher. Now, another theme you're going to hear from these forecasts is a shift in leadership. Goldman Sachs, for instance, thinks that the Mag 7 tech stocks won't dominate as much next year. The rest of the market will start to catch up rather than just being pulled higher by big tech alone. That catch-up idea shows up a lot in these forecasts. One more interesting factor some analysts are paying attention to is fiscal policy, like tax refunds going back to consumers, hundreds of billions expecting to be returned early in the year, boost consumer spending, help earnings, and while these targets give us a range of expected blah, 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 blah. Guys, it's all gibberish. They pick a number and figure out whatever they need to do to justify that number. Anybody says otherwise is a sucker. If you don't know who the sucker is at the table, you're the fucking sucker. Okay, that's it. They need to justify a higher price, and they say, well, based on the way corporate earnings are going and the way AI is changing the way the world works. And guys, can I ask you a question? If people stop buying the Mag 7, the Mag 7 falls while they buy other things, you know what's going to happen in the stock market? It's not going to go well. He just showed that. 35% of the S&P 500 is the Mag 7. Guys, valuations are insane. Investors keep paying a premium. Prices relative to earnings. AI adoption translates into real profits for businesses, not just hype. I get that. But what if that suddenly stops? What if all of a sudden everything we assumed about fiscal monetary support stops? What if inflation goes up even higher? Now, here's an article that came out right at the end of 2025, just recently. Every Wall Street analyst now predicts a stock rally in 2026. Guys, can I explain something to you? Tim yesterday, our CEO, main producer, he said to me, Paul, there's an article on Yahoo Finance, and they said the second he said every, I was like, it doesn't say every, Tim. Nobody would be that stupid to write that in an article. He pulled up the article. I didn't say this to him, by the way, because I didn't want to hurt his feelings because, it's just one of those things where I didn't want to be like, Tim, stop. It's not every. Then he opened it, and I saw that word. And I was like, every fucking Wall Street analyst now predicts a stock market rally in 2026. Every single one. They're not even open to the fact that it could end. By the way, I don't know what's going to happen. I will never, ever, me making predictions is 12, 15 years ago. I will never do that again. It's literally impossible. Now I troll people. I take screenshots of predictions. I save them on my reminder list. I put them on Twitter. And then just yesterday on Twitter, by the way, if you want to follow me on Twitter, @EMPaulG, I pulled out a bunch of Bitcoin people and said, look what Michael Saylor and all these two other idiots guessed Bitcoin would end up at the end of 2025. And they were all massively wrong. It's not an attack on Bitcoin. It's an attack on forecasts. They're all a guess, but people love seeing them. So before we move on, I want to talk about something really important when it comes to these Wall Street forecasts. How often they're actually correct. Because just like analysts can predict a range of numbers for 2026, they've been doing this every year for a very long time. When you look back to the data from 2021 through 25, you start to see a pattern. In 2021, the consensus estimate for the year was about 4,100 in the S&P, and the market actually ended up higher. They underestimated by about 10%. 2022, consensus was 5,100, but instead the market fell 20%. Wall Street was too optimistic. They overestimated by about 9% compared to what actually happened. In 2023, Wall Street forecast around 4,000. Why, guys? So think about it this way. 2021, market was up. They forecast a higher market. 2022, market was down. They forecast for 2023, a lower market. But they missed the biggest driver of that year, the pivot to AI-related growth. Nobody saw that. So in that case, they underestimated. Do you see a pattern forming? Everyone looks back very recently. It's called recency bias. Then 2024, the consensus prediction was 5132, and the market came in above that. On average, analysts were about 15% too low. And in 2025, the expectation consensus was 6,600. And that one came in a little low, but reasonably close. So last year was one of the few times that they were pretty close to reality. If you take a longer view, say the last 20 years, the historical pattern is even more interesting. On average, The broker consensus estimate for the S&P tends to be about 7% higher than the market actually returns. And in 13 of the last 20 years, Wall Street analysts have overestimated returns. That means their predictions were too optimistic more often than not. Put another way, Wall Street is right only about 47% of the time. Guys, that's less than a coin flip. Even with all their research tools, models, and data, they still miss the market more often than they hit. There's a reason for that. And it ties back to how predictions are made. Analysts are prone to recency bias. They will assume that what just happened is going to continue to happen. When markets have been rising steadily, forecasts tend to be too high. And when they're wrong, they usually miss big, way more than they miss small. So when I talk about the market being overvalued, I'm not telling you to time the market or sit on the sidelines waiting in cash. I'm telling you just to be careful and manage your expectations. Understand price versus value and prepare for volatility. And here's the thing. When the market finally does fall, as crazy a statement as that might be, Wall Street will want to tell you stocks are broken or bad. But disciplined investors, those with a plan and an understanding of fundamentals, can see that moment as a buying opportunity, not a disaster. The key isn't trying to predict perfectly. It's about building a process that lets you stay calm, make smart decisions, and take advantage of the opportunities that arise when fear and greed push prices out of line with value. Now, I'm going to tell you guys, the mistake I made was seeing the market so overpriced and thinking there's no way I can find value. There's value everywhere, because if a few stocks are leading the market up, that means a lot of other stocks are being left behind. Those are the stocks to look at. So if you want to see companies that fit my investing process, the ones that I think were ignored while these other 7 stocks drove up high, I picked 7 stocks that I believe will beat the Mag 7 over the long run. And I'm going to be honest, 2025 results did not all year go as expected. And you have to watch the video to understand what I mean by that. You're going to want to see who made the list and what happened for the year. So click the video on your screen right now. I will see you there. Thank you for your time.